Welcome to the Investors Management Group webcast presentation for first quarter 2020 for Foster Creek. We appreciate your participation today. Our goal of today's webcast is to present a high-level performance update on your investment with us. We value our role as your asset manager, and we hope that today's conversation surrounding Foster Creek delivers useful information for your understanding of your real estate asset and the current real estate environment. The hosts of today's webcast are Carlin Conklin, an IMG Principal and Executive Vice President, Michelle Rivnak, Managing Director of Asset Management, and myself, Dave Mickelson, Investor Relations Manager. Also on the call from IMG is Andrew Schoaf, IMG's new Senior Asset Manager. Prior to joining IMG, Andrew held the position of Regional Property Manager with Pinnacle Property Management, overseeing a portfolio with over 1 million square feet. He recently arrived to Portland from the Twin Cities and is already making big contributions to our asset management team. Welcome to Andrew, and we're pleased to have you with us. Today we'll be presenting a review of what we've achieved for quarter 1 2020 operations, as well as updates on capital improvement projects, owner reserve balances. Additionally, we'll be focusing a large part of our discussion on the economic impacts of COVID-19, what we've experienced in April at the property level and industry level, and how we're navigating for the future. I'll remind everyone of a few features for our presentation today. First, all the participants will be on listen-only mode during the presentation. For those joining with web feature, I'll encourage you to submit questions through the live chat pane. You can click the chat bubble and choose to send your message to either the organizer or to everyone. For those not on the web, feel free to send questions to me directly at david.mickelson@imgre.com. I'll collect questions during the presentation, and we can address those during the question and answer segment at the end of the call. So with that introduction, I'll turn it over to Michelle for a review of Foster Creek first quarter performance.
Thank you, Dave. Good morning, everyone, and thank you for joining us. Hope everyone is doing well and staying safe out there. So we will start out with our Q1 2020 financial review and look at our budget to actual numbers and look at our performance. So we'll start with our net potential rent. We are operating the budget with a 1% variance, so we're slightly higher than expectations. We are budgeted to bring in $728,000, and our actual is $736,000, with a positive variance of $8,000. Our rent adjustments were budgeted at $45,000. Now that's going to be concessions, employee units, model units, and vacancy. So we were budgeted $45,000, came in at $14,000, which is great news. And we've got a positive variance there of $31,000, which brings our total net rental income. We were budgeted at $682,000. But we came in at $722,000, which gives us a positive variance of right at $40,000. So 5.8% over budget expectations. Our other income and miscellaneous income, that is operating exactly to budget with a $350 variance over the quarter. And our total income was really successful, 5% over our budget expectations, or a $40,000 positive variance. We're looking at expenses. We were budgeted to have expenses at $305,000, and we came in better than that at $290 for actual spend, which is $15,000 to the good, or another 5%. So then when you look at our net operating income, the budget number was $473,000. Our actual net operating income for the quarter is $527,000. which puts us at a $55,000 or 11% positive variance for the quarter. I do want to highlight our debt service as well. That was budgeted at $237,000 for the quarter, but it's slightly higher at about $241,000. So we will see an overage right there of about $3,500 per quarter. But our net operating income is certainly adding to the surplus there. So that's a review of this quarter. And I'd also like to show you, since we've held Foster Creek for a while, a year over year, where were we at this time, Q1 last year versus where we're at today? And the news is good. Our net potential rent shows solid growth, increasing by 3.7% since this time last year. And again, we're seeing favorable occupancy. Our vacancy is actually half of what it was last year. For operating expenses, it ticked up by 1.3% if you're comparing actual to actual, but we're under budget for this year, so it's even better than that number you're seeing there. And total income increased by 5.2%, and net operating income is up by 7.4% or $39,000. So all in all, Foster Creek is marching right along, and I'd like to review what we have in our reserve summary. If you look through our next slide, this is just a high-level view so you can see what we've got in the bank that's owner-controlled and what we have that's lender-controlled. In our operating account right now, we have $84,293. In our CapEx reserve, after our refi, we've got $1.3 million, and that is for the remainder of the hold as we do asset preservation projects, and I'll touch on that a little bit more in my capital slide coming up. So our total owner reserve is $1.4 million, and then we do have funds held with the lender. We've got a replacement reserve at $24,500. Our real estate tax escrow account is at $132,000. Our insurance tax escrow account is at $16,000, which puts our lender subtotal reserves at $173,000. So you can see from this, we're very comfortable in a cash position. And we can go to the next slide that will show you a little bit of our capital overview. So we've held this property for a while. We've done a lot of the work already. We have $1.3 million ready to go as projects come up. So we're putting together a comprehensive 5-year capital plan. So in ways that we can do asset preservation projects as well as income generating projects. When it comes to interior unit renovations, we are really taking those on a case-by-case basis now in our new environment. We want to make sure that we are, while we're conserving cash, we're also doing upgrades that we're going to get the benefit from. So we're looking at units as they get turned back to us as they're vacated and looking at the condition and making case-by-case decisions on how we're going to proceed. For exterior capital projects, we don't have anything scheduled at this time. When we're able to travel again, we'll be back out there and putting together this is kind of our plan for asset preservation. But we're looking at those projects, anything that needs to be taken care of, such as mechanicals or plumbing, safety risk concerns, we will be completing those as needed. So we can go to our next slide. And this information is about our Federal CARES Act. And with that, I'm going to turn it over to Carlin to walk through this information with you.
Thank you, Michelle. Our job as your asset manager is to oversee and ensure the health of your investment. Prior webcasts presented the updated value of your investment, major capital projects to add value, and the market. As you can see, this webcast is and will be quite different. Michelle spoke of first quarter performance and also showed you the reserve accounts and projects that are on hold right now because we are preserving cash. There is no sense spending money on projects if you cannot get an economic boost. The number just came out this morning that the GDP fell 4.8% annualized in the first quarter due to COVID-19. And most of that decline was actually driven in March. And it's going to get worse. We will come out of this, but we do not know how long or how deep this contraction will be. Therefore, we are spending this next section of the webcast focused on government-driven relief programs and how that impacts Foster Creek. Now, Foster, in comparison to many of our other properties, is very, very healthy. It has moved into this downturn in a very, very healthy position. We have very healthy reserves, but there are still programs that we would like to discuss with you so that you are aware of what we are focused on. I'm going to start with the Coronavirus Aid, Relief, and Economic Security Act of 2020, which is referred to as the CARES Act. The act has components that help renters as well as components that help owners. We are pursuing all programs that have a potential of benefiting our residents, our properties, and our bottom line. As regard to renters, there is an eviction moratorium for all properties with Freddie and Fannie loans. And as you are aware, we have a Freddie loan here on Foster Creek. We cannot pursue evictions through July 24th, nor charge fees or penalties related to non-payment or late payment of rent. Evictions historically are the stick we use in this industry, but we can't use a stick, so our strategy is to use a carrot. Our management companies and on-site staff are taking a soft approach, relying on relationships with residents, working on payment plans, and capitalizing on residents' desire to keep their homes on the other side of this pandemic. The property staff is trained to talk through the programs available to renters, such as the stimulus checks of $1,200 per adult and $500 per child. These checks are currently in process. Secondly, state unemployment benefits are expanded to provide a federal check of $600 a week for a maximum of 9 months. In states like Oregon and Washington, that total weekly unemployment benefit can be upwards of $1,200 per week. For those with student loans, the loans are automatically entered into forbearance through the end of September, so that additional household money could be applied towards rent and other living expenses. And finally, the CARES Act provides expanded sick and family leave for those who are directly impacted by COVID-19. The Act also offers financial assistance for businesses with employees and mortgages. There's been a lot of press about the PPP, or Payroll Protection Program. The first round was signed into law April 3rd. The second round happened last week. The PPP has been allocated a total of $659 billion in small business loans, as well as what is referred to as payroll protection for those businesses with 500 or fewer employees. The loan is forgivable or converts to a grant, provided certain levels of employment are maintained for that 2-month period. The goal of this program is to keep people employed. Foster Creek is managed by Allied Management, and they have fewer than 500 employees in their company. Allied has chosen at this point not to apply for the PPP. We are okay with that, given the fact that Foster Creek is so healthy at this time. Many of you are investors in other properties within the IMG portfolio, and we'll discuss how the PPP affects those properties also. But for now, with Allied for Foster Creek, we will not be applying for that loan for the employees that are employed at this particular site. Go ahead and advance the slide, please. What is important is, and we've had a lot of questions from investors regarding loan forbearance, which again, you can see because of the healthy nature of Foster Creek, we do not intend on applying for forbearance with Foster. It's doing well. But for your information, the forbearance program provides relief for multifamily mortgages, given renters cannot go to work or be evicted. The forbearance program defers 3 months of mortgage payments with no penalties or fees. After that, the deferred amount is paid back over a 12-month period. We will likely apply for forbearance on half our portfolio with the goal of building reserves over that 3-month period of time. You know, none of us knows how long this pandemic will go, nor how deep it will hit. The forbearance is loan payment suspension, not forgiveness. With Foster Creek, as you can see with our loan, we have 7 years of IO. We have 5 years remaining. It's with a fixed rate. A lot of investor questions right now are questions with investors who are very, very concerned about the loss of a property. because they lived through 2008 and 9, when many people did lose their properties. Be aware that one of the biggest reasons people lost properties back in the Great Recession was because a loan came due. The very, very good thing about Foster, along with all the other properties in our portfolio, we have no loan due at any time in the near future. And so we will weather this. Foster has huge reserves, a strong loan, IO for the next 5 years, so we will weather this storm. The next slide talks about the sensitive analysis that we have worked on. Many of you attended our COVID-19 webcast on March 19th. If you were not able to attend the webcast, the transcript and slides are available in your portal. We determined shortly after that webcast that the critical questions on many of your minds were, 1, how far could collections go down before the property required a capital call? And 2, where is break even? We spent the next several weeks reviewing reserves, capital accounts, and operations, and completed a sensitivity analysis on every property in the portfolio. The break-even percentage is driving our conversations and actions regarding every property. So Dave is now going to take a few minutes and walk you through Foster Creek's analysis and talk to you about what the numbers mean and the implications. So Dave, I'm turning it over to you.
All right. Thanks, Carlin. Well, great introduction. Like Carlin mentioned, this was at the top of investors' minds and the top of our mind. You know, how can we perform in this COVID-impacted environment and reach certain benchmarks? And so I'll explain kind of these sensitivity tests that you're seeing here on this slide. As a baseline, we took the column on the left, which is our trailing 3-month income, and our trailing 12 months of expenses, and called that kind of our baseline or our stable operations. For our first sensitivity test, titled break even, we ran a scenario at, you know, what kind of net collections loss could we bear, still pay our expenses and our debt, and break even. So you'll see in column in the middle, sensitivity test number 1, break even, the first highlighted row that says additional deduction to total collections, you'll see a 30%. That's the total loss in total collections that we could bear and still break even with the expenses and the debt service, with a few assumptions, and I'll explain those too. In the far right column, this is more of a severe, maybe a worst case scenario. The 50% is not related to the property in any way, and we'll talk more through that, but just a 50% scenario that we ran for every property to kind of see what the net cash flow would be annually and the net cash flow would be monthly. And you'll see at a 50% loss in total collections, our annual cash flow loss would be $626,000 and our monthly loss at $52,000. So if we go to the next slide, I'll explain some of the assumptions that we made, because we did make some fine tuning in our expenses to kind of arrive at this scenario. So that you'll see in the first bullet point a repeat of what we talked about in the prior slide. We can break even at approximately 70% of our trailing collections. That allows for a loss of 30% between our rent collections and our other end collections to still break even. And the assumptions that we made for operating expenses, number 1, we increased utilities by 20%, assuming that with people, on furlough or laid off or at home, that we'd have a 20% higher expense for utilities. We also assumed that turnover would decrease. There's not as much velocity in leasing or people leaving to search for other apartments, and so we reduced that expense in turnover. And then, of course, our property management fee and our asset management fee, both of those are percentages based on gross revenues. So as our total collections drop in both scenarios, that asset management fee and that property management fee drop as well. And then, of course, this property has a fixed rate loan, so we kept the debt service expense constant, and that was carried through all scenarios. So you'll see how the break-even analysis kind of plays into how we're tracking collections as we get into the next slide with Michelle It's something that we're tracking daily, and she'll explain kind of what that number means.
Thank you, Dave. So the information of we will break even at 70 asks, so where are we now? So if you look at this slide, there's a lot of detail here, and our first column is April billing. So this is the total amount of rent only that was billed to the residents in the amount of $239,927. Of that April rent, we collected $214,505, which is 89%. We also collected other income, which is your other fees and things like that, in the amount of $26,256. If you put that all together, that's our total collected, and that's where our break-even analysis is based on. Our total collections were $240,000. Our break-even income is $189,895, which gives us a positive number of $50,866 for April, which is also 127% higher than your actual break-even number. So this is the important part to see is we have this extra $50,866, and that's what we're holding on to, and to be cash conscious as we move forward. For occupancy, when you're looking at Foster Creek, we're sitting in a good position. We're at 97.8% occupied. And right now we have 3 payment plans. In our normal course of business, we wouldn't allow payment plans, but as Carlin mentioned, we are now operating in this CARES Act environment where we are, during this time, not able to evict residents or charge any late fees. So we took this as an opportunity to become very flexible on payment plans. Our site teams are working with each resident that has been financially impacted to customize a payment plan that they can actually perform to. And this benefits us in kind of 2 ways. It maximizes our rent collections throughout the month, and it also keeps those residents engaged with us, and it keeps them coming back. It gives us something to talk with them about. So their rental obligation is in front of their minds. You'll see that also we've got the month-to-date total collections versus the trailing 6 months. So we've collected, compared to the last 6 months, $240,761 versus the $266,000. So we're at a 90% of our 6-month average. You'll see the comment here that surveys generally anticipate May collections to fall below April collections due to the rising unemployment. And I do agree with that, but I also think that we're just going to see a different trend starting in May. We're used to seeing all of our rental collections, the majority of it at least, come in within the first week of the month. But I think we're going to start to see more payment plans as people are relying on unemployment benefits and other stimulus funds to make their ends meet. There is a lot of data to analyze and news to follow about these payments coming out and the timing. And I think it's important for you to know that we are tracking each payment at each property on a daily basis. We are approving all of the payment plans on a case by case, and we are reviewing the performance of those payment plans on a weekly basis. So as Dave and Carlin will touch on later, we will have an additional webcast on collections and reforecasting at the end of the month. And from there, we can kind of move to our next slide. I've got just a little bit more for you on our demographics. So part of this is understanding where our residents work and how much money they make and what they're going to be qualified for. So it's a really in the weeds with our residents here. But if we look at our household, our income, we're anywhere from about $30,000 to $60,000. If you look at our pie chart here, we have a mainly workforce-based resident demographic, but we also have 45% of folks in skilled trade and professional and medical. So you're going to have your folks that still are working, they're working from home, and then you're going to have some folks that were working at either the airports or the retail or hotels around in that area that will be impacted. So like I said, we're following it literally on a day by day and really working to push collections, but I feel that we're in a pretty good spot with Foster. And with that information, I'm going to go ahead and hand it back over to Dave, and he can give you some highlights we're seeing in the news.
Thanks, Michelle. So as we've covered, the impacts financially of COVID-19 are on everybody's minds, and that's common across the real estate industry. But there are a few bright spots that support an optimistic perspective for Class B multifamily like Foster Creek. So just to highlight a few recent publications, yesterday Moody's Analytics and Reis published its first quarter report and noted on a relative scale, multifamily is likely to experience less distress than other property types, specifically relative to retail, hospitality, and office. And this has really been the general industry consensus. There are a few data points that support Moody's opinion. First, multifamily vacancies have trended to near record lows, given how well the sector has performed over the last decade. We're starting off now from a lower vacancy in this cycle, which is under 5% relative to the 2006-2007 period, when vacancy was approaching 6% already, and multifamily vacancies actually began rising as a response to the housing market bust. Second, the Moody's Analytics forecast models some countervailing effects like a decline in new construction as a response to the economic slowdown. So in Moody's scenario, the 300,000 plus new apartment supply construction figure at the national level is cut close to 50%. And though vacancies rise, the drop in new supply supports some occupancy levels quite a bit. Also, multifamily specific reporting, such as Multifamily Biz and Multifamily Housing News, point to Class B apartments as being the best defensively positioned apartment type. The reason is that Class A renters are generally more mobile and likely to move to other housing locations or to more affordable housing, while Class C renters tend to be more impacted by the rising unemployment and have lower reserves of savings to draw from. All this isn't to say that our Class B product won't feel substantial impact, but that our segment should perform the best relative to some other rental housing types. Going back to what Carlin covered in her recent Kiplinger article a couple weeks ago, we believe the underlying fundamentals that have supported apartments through this cycle are still in place and should sustain robust demand for rentals in the long term. Additionally, IMG's deal structures are conservative and have provided some safety through this period. One of the biggest risks in the downturn is loan maturity, which we don't have occurring at any property through the next 5 years. Also, high leverage or construction financing is another huge risk that we don't have in the portfolio. And last, all but one of our loans is through Freddie Mac or Fannie Mae. Carlin talked about the Freddie Fannie loan forbearance program. That gives us a valuable option if we need it. And with interest rates dropping to record lows, our properties with variable rate financing will really benefit a lot from substantial savings on debt expenses with that tailwind. So as a last piece of relevant news to share, that's the IRS 1031 exchange extension. Obviously, with buyers and sellers facing some unique challenges to get deals done, the IRS has granted extensions on both the identification and the close date timelines through July 15th. It still remains to be seen whether this will extend further, but for now it offers some immediate relief on exchange timing pressure. So those are just some highlights. We'll move to our next slide. So with the mention of the 1031 exchange extension, I'll briefly present a property we have in contract as a potential exchange and investment candidate. We're in contract with an extended due diligence period and closing date to acquire Apex, a 324-unit, 1996 built value add property in San Antonio. The property fits our acquisition criteria well and represents a new compelling market for IMG. The current ownership has recently spent $1.3 million on interior renovations for about a third of the units and about $650,000 on community upgrades such as full exterior paint, updates to the pool area, the fitness center, and a full clubhouse renovation. Prior to those improvements, roofs were fully replaced and all windows and exterior doors were replaced at an expenditure of more than $6.5 million. So we appreciate the fact that the asset has received extensive building envelope rehab. Those are low return on investment expenditures that won't be necessary during our ownership period. So our investment strategy will follow our proven pattern of continuing a light value add upgrade on unit improvements and the goal to keep driving rents as they've been going in the past. So we've been impressed by the North San Antonio submarket where Apex is located. High single-family housing costs create a barrier to home ownership, which is nice for us and puts us in a defensive position. Apartment occupancy has been strong there. The property is surrounded by major thoroughfares and retail centers. And then a great highlight is that Bexar County, where we're located here with Apex, ranks 6th nationally in population growth. So we like the price at $125,000 per unit. We see the solid fundamentals. Just like the rest of our portfolio, we're monitoring collections daily on Apex. We've negotiated for a closing window through about September 1st, and we're planning to be on site conducting our due diligence as soon as we can. So if you're interested in more detail, please let Carlin or me know, and we can send an overview package. So that'll conclude our webcast slide presentation and leads us into our question and answer segment of the call. Again, if you'd like to submit a question, you can do that in the chat pane, or you can email me at david.nicholson@imgre.com. So I've received a couple questions so far. We'll cover those, and then we'll also touch on some common questions that investors have sent to us over the past couple of weeks. So let me start with one about the rent collections, and I'll send this to Michelle. I know you touched on it just for a few moments, but how are we dealing with rent that's not collected at the time that it's due?
So communication, and on a case-by-case basis, honestly. With the CARES Act, we can't send out your rent is late, we're going to evict you type of scenario. That's the normal course of business. So if your rent is due by the 5th and you haven't paid by the 5th, we are on the phone with you, we're knocking on your door, we're talking to you, and we're creating payment plans. And I think the key of that is to keep the residents engaged. We don't want anyone to go dark and to feel like it's a hopeless situation or they're not going to be able to pay. So we encourage them to sign up for unemployment and the stimulus payments that are coming in. There's a tricky thing in timing, and it's a little different state by state. Washington State actually was impacted by COVID early on and shut down sooner than some of our other markets. So that unemployment really started to push out a little bit earlier. But we're seeing the federal amount, that backup of $600 per week, has been a slow coming out. So as we talk to the residents, we're letting them know that there's resources, that there's ways to pay, that we're going to be engaged with them and just constantly in communication with them. And if they can pay us $300 this Friday and another $300 next Friday, we'll track it. We'll create a payment plan that goes into May and June, depending on how it goes. So our goal is to keep the residents engaged and just simply collect as much of the rent as possible in whatever format the residents are able to provide it. So I hope that answers the question.
Yeah, that's great, Michelle. Thanks for the extra detail.
So Michelle, real quick, this is Carlin. Real quick, what happens when I read this question? What I think I'm reading is, what happens if we hit July and this particular resident has been working really hard, paying us $200 a week or $400 every 2 weeks or whatever, and they have a balance at the end of that time? Have you or the management companies discussed what we do on the other side of this? Or right now, are we still working on a policy?
So there's a few ways that would go. If the resident is engaged and wants to pay the balance, then we'll take the balance. We'll figure out a reasonable payment plan. In some cases and in some states, some leases, residents are allowed to allocate their security deposit. So if we really have somebody that's in a bind and they've got a $1,000 security deposit, they can use $500 of that towards the rent balance in some cases. So, we're open to being creative and keeping them there. If someone isn't paying, they're not following up with us, then we will have really no choice but to go to the eviction route once that becomes available again. So that's the reason as our goal is to keep that communication and keep them engaged with us. Does that answer your part? I think there's one other segment to that as well is when this is all over. So right now we've gone kind of outside the lease terms where we can accept payment plans. We'll have to send out a letter, like a legal notice to the residents that we're going back to the lease, with change of notice and terms, so they know we're back to rent is due on the 1st, and we'll do that to establish the line in the sand of normal operations versus like our post-COVID operations.
Great, thank you.
Thanks, Michelle. Now I'll send a question to Carlin. Carlin, what happens to the money that we're collecting that's in excess of our costs? Do we hold this in an account and distribute it later?
Yes, so there's a couple of parts. Foster Creek is extraordinarily healthy. We have very, very healthy reserves. We are over break even in our collections this month. But we don't know what's going to happen in May, and we don't know what's going to happen in June. We just don't know. And so excess cash today is remaining within the property's operating account, which is where your distributions always come from, is they're sent out usually around the 1st of the month out of the operating account. That money will accumulate there. If we move faster through this pandemic, I mean, like I think we're all optimists, we hope, we will begin distributions as soon as we can. But we believe as your asset managers that we have to put a brake on distributions right now because we don't know the future. We are sitting on $1.3 million. That is something that we could tap for distributions. But again, we're asking for your patience. We need to get through May and into June so that we can see what is in front of us. Also with Foster, as you are aware, this is a 70s product. It has physical issues that we want to maintain over the next 5 years of the hold, and we have that reserve for that. So we will be balancing all of those things as we discuss that with you over the next several months until we get to the other side of this pandemic. But that was a very long answer to a question that was simple, and that's basically what happens with this excess money. It will be sitting in your operating account.
Okay, great, Carlin. Thank you for that. Well, I'll touch on a couple questions that have come to us that seem to be general and pretty common and probably on the minds of a lot of people on the call. And so I'll start with this one for Carlin. The question is about staying current on mortgage payments. You know, if May is a tough month and the summer months are tough months for collections and we can't receive income that helps us break even, what are the different scenarios for meeting our mortgage obligations?
So what we would do with Foster is, as you can see, can we pull back to the reserve slide on the thank you. Let's pull back to the reserve slide real quickly. So what we can see for Foster is our operating account is sitting at around $84,000 as of several days ago. We're going to put additional monies into that operating account because we did far better than break even in April, and we'll build up that balance. So if right now we have several months where we can just pull from operations to make this mortgage payment, we also have that CapEx reserve. So secondly, after working with our operating account, if it goes lower, we can always pull from CapEx reserve on this particular property. That would be the scenario that we would follow. We cannot see in any way, shape, or form that Foster Creek is going to get into trouble, given the level of reserves that this property has. But again, we're asking for your patience. We are not going to do distributions until we understand May and June. So that's what I would say with Foster Creek.
Okay. Well, that it's in some ways answers the other questions that follow here that have been pretty common. Cash call is always dreaded among owners, but it's always important to discuss when you're looking at all possible scenarios. How likely, Carlin, would you say cash calls are for IMG investors in Foster Creek, and how would those work? Also, is there any likelihood of a total loss of investment?
Yes. In fact, let's go to the slide that shows the sensitivity analysis. Thank you. So even across our entire portfolio, we said, what's the likelihood? I mean, people need a place to live. Most people are getting some level of aid today. And we said, what is the absolute worst case? And we said maybe 50% of collections. So if you look at Foster Creek, if we only hit 50% of our collections, we would have a deficit cash flow of $52,000 a month. Now, we've already looked at the cash accounts. We know that even in this worst case scenario, we can cover all of our expenses. We can cover our debt at Foster Creek. And if we have to go into our capital account, we can absolutely do so. But let's say we didn't have that capital account. What an investor would do is say this. Let's say I owned 10% of Foster Creek. And we have this worst case scenario here. I own 10%, heck has fallen on my head. I would have to come to the table with $5,000 a month to cover my obligation. And if people go back to their operating agreements and their tenant in common agreements, there's the whole scenario of what happens if there are capital calls and what happens with dilution and things like that. We don't believe that's going to happen. But if you are concerned, please go back to those legal documents and look into it. But that is why we did the sensitivity in this way, so that you could look at that. You could also see your cash accounts, and you can sleep at night. And I think with the break even, one other thing I would like to say about Foster is this. And in fact, those of you that have a lot of interactions with Neil, I'm sure you've heard it before. We all have always referred to Foster Creek as it just prints money, and it kind of does. It just prints money. It is absolutely workforce housing, but the workforce in the Seattle market is a highly, highly paid workforce because there are so many jobs, so many major corporations. The minimum wage is $15, but very few people make the minimum wage. They're all making more. And so when something like this pandemic and these shelter-in-place orders come in and everybody stops, that's one of the reasons why you see that if rent collections were about 89%, we have properties that are over 90, hitting 95. This one, there's people at first somewhat struggled because if they can't go to work, have to wait for things to kick in. With that said, we are still well over break even. We have very, very healthy accounts. And those of you that have ownership in multiple properties, my thought right now is this is the one you don't have to worry about.
Okay. Well, thanks a lot.
So back to you, Dave.
All right. Well, that'll wrap up our question and answer segment. And if you have a question that you didn't have a chance to ask, or if something comes to mind later, as always, feel free to reach out to me or Michelle or Carlin with any questions. So thanks again to everybody for your time and your questions today. We'll continue to prioritize the health of our residents and the performance of your investment through the COVID-19 impact. IMG is focused on growing your equity over the long term and resuming owner distributions as soon as it's financially prudent. To keep you informed during the evolving market, we're also planning to host a special update webcast at the end of May. The presentation in May will provide a recap of April performance, collections for May, a 2020 recasted operating budget, and updated news. Our goal is to communicate openly and often as we navigate through the financial effects of COVID-19. We'll send invitations to you for the May webcast when that schedule is final. So to close, I'll note that monthly reports for Foster Creek have already been posted to your investor portal. Quarterly reports and the recording of today's presentation will follow in the next couple of days. So this will conclude our first quarter 2020 webcast for Foster Creek. Thank you for your partnership. We look forward to speaking with you again soon. Have a great day.